This is week 9, lecture part 2. We're going to consider the Social Security program in this lecture. This is Title II of the Social Security Act, as we've seen before. The formal name given to our Social Security program is Old Age Survivors Disability Insurance. This is the largest social insurance program that we have in terms of the sheer number of recipients and the amount of dollars that we spend. And we'll take a look at some of the basic features. We'll look at eligibility, we'll look at the benefit structure, and we'll look at the financing challenge. The main policy issue here is about financing. And so we'll take a look at some of these aspects here. But first, just a quick review of social insurance programs. We saw how social insurance programs are going to be near universal. As long as you meet certain categorical requirements, you fall within a certain category. You're aged, you're disabled. As long as you have a certain work history, you're going to be eligible for social insurance programs. There's near universality to it. They're not means tested, so you don't have to have low income and assets to qualify. We've seen how they're typified by dedicated earmarked taxes. You have taxes going to a very specific purpose. We'll look at how our Social Security program is financed. And then, of course, we saw how social insurance programs overcome issues of adverse selection and moral hazard as a review. So this is just a quick poll from the New York Times asking college students what they think about their prospects for receiving Social Security benefits. So the poll asks this. They say, when I turn 67, that is become eligible for full Social Security benefits, I expect that. And then there's a series of answer choices. A, the answer choice is, I expect no benefits. B, I expect, so adjusted for inflation, I expect benefits that are less than half of what current retirees receive. Answer choice C has to do with adjusted for inflation. I expect to receive somewhere between 1/2 and full benefits. And then answer choice D says that adjusted for inflation, I expect to receive benefits at least as much as what current retirees receive. Those are the answer choices. But the point of including this material is just to note that most college students, when polled about their prospects for receiving Social Security benefits, a majority respond either A or B. So there seems to be a sentiment that most people think that Social Security won't be there when they retire. And we'll get to this financing challenge and why it is that many people think this. There's a financing challenge in place, and so we'll take a look at the nature of that challenge later on in this lecture. But first, a little bit about how the system is financed generally. We have the Federal Insurance Contributions Act, or the FICA, which establishes the funding mechanism for this program and also for Medicare. But we have the Social Security Trust Fund. The way it works, you have a dedicated earmark tax, we said. This is an employer-employee tax, a 6.2% tax that's assessed not only on the worker, but also on the business for which the worker works. So cumulatively, it's going to be a 12.4% tax, right? If you take the 6.2% that the worker pays and the 6.2% that the employer pays. So added up is a 12.4% tax on the worker's earnings up to a capped amount. So that cap, that maximum taxable wage base, that's the formal term that's used, is $110,100 for 2012. So up to that amount, you're going to be taxed at 6.2%. And then beyond earnings beyond that amount is not subject to Social Security tax. That's the basic mechanism that's put into place via the FICA legislation. The FICA also provides for the Medicare tax. The Medicare tax, like the Social Security tax, is assessed on both the worker and the business. So it's a 1.45% tax, or in other words, 2.9% total. And there is no cap on the amount of earnings that's subject to the Medicare tax. This is a tax on earnings, and so the rules distinguish between earned income or earnings and unearned income. By way of example, things like your wages. If you're working at Starbucks, your wages, those are earned, that's earned income, so that's going to be subject to the Social Security and Medicare taxes. If you're self-employed, you're also subject to these taxes. If you're working in a sheltered workshop, if you're a person with a disability working in a sheltered workshop, that's also considered earnings. If you've published a book and you're receiving royalties on the book, that's considered earnings as well. So the point here is that this is a tax on earned income and not on unearned income. In terms of the eligibility for the program, when I go through some of these rules, I'm referring specifically to the rules that apply for retirement benefits. There are different rules that apply for spousal benefits, for survivor benefits, and for disability benefits. They're a little more convoluted. They're a little more complicated. And so these rules that I'll outline for you are with respect to the retirement benefit. But in terms of eligibility for retirement benefits, they're going to look at your work history essentially. So it's based on a credit system. You must establish or accumulate 40 credits over your lifetime. Those credits, each credit approximates about one quarter of work. So if you do the quick math, it comes out to about 10 years of full-time employment that will make you eligible for Social Security retirement benefits. So recall that this is a tax that both the worker and the employer pays on earned income. In terms of the benefits, like I was suggesting before, there's a retirement benefit, there's a survivor's benefit, and there's also a disability benefit, and they have different rules in terms of how the benefits are calculated. And so we're going to take a look, just by way of example, at the retirement benefit and how that's determined in a moment here. But just a note about how Social Security is financed. Social Security is based on a pay-as-you-go financing system. It's a pay-as-you-go system. What that means is that current workers will pay for current beneficiaries. So it's not what many people think. It's not that you have an individual retirement account that's being managed by the Social Security Administration. The FICA taxes that are assessed, the revenue that's collected, goes towards payment of the benefits for current beneficiaries, and the remainder will go into the Social Security and the Medicare trust funds. That's what we mean by pay-as-you-go system. It's not, like I said, the individual retirement system that many people have in mind when they think about Social Security. In terms of that tax that's assessed on the workers and the businesses, recall that we have different types of taxes. We have progressive taxes, regressive taxes, and proportional taxes, and we've outlined what those things mean already. And so looking at the structure of the Social Security tax, I ask in your slides, I ask how progressive, this is a little bit of a trick question here, but I ask how progressive are Social Security taxes? Well, we just noted that based on the FICA legislation, there's a 6.2% tax that's assessed on earnings up to a capped amount. So if you consider different scenarios, if you have a low income worker who's making, say relatively speaking, this person is low income, this person is making $30,000, that person will pay 6.2% on the first dollar that that person earned, and also on the $30,000 that that person earned. So it's a flat tax up to $30,000 for that person. If you consider a person who makes a little more than that, so someone who's right at the capped amount, someone who makes $110,100, that person will pay 6.2% on the first dollar, will pay 6.2% on the $110,100. So that's also, it's going to be flat all the way up to the capped amount. So up to that amount, we can say that it's a proportional tax. But then you have to consider a higher income worker. So let's say you have a person who's making $500,000. That person is going to pay 6.2% up to the capped amount, but earnings beyond $110,100 is not going to be subject to Social Security tax. And so if you think about actual versus marginal tax rates, the marginal tax rate will be 6.2% up to the capped amount, but it's 0%. The person pays no tax on earnings exceeding the capped amount. So if you calculate the person's actual tax rate for a person who makes $500,000, it comes out to 1.37%. And I show you the calculation in your slides. And so back to the original question of how progressive are Social Security taxes, if we're considering all levels of income, this may be characterized as a regressive tax because it's going to be more favorable for the higher income worker relative to the lower income worker. The higher income worker that we considered as an example, the $500,000 worker paid a 1.37% actual tax rate, while the $30,000 worker paid a 6.2% tax, and that makes it regressive. As you move from lower income levels to higher income levels, you have a decreasing or declining tax, and so therefore this is, in fact, Social Security tax is in fact regressive in nature. Now, we're assessing progressivity, regressivity in terms of the benefits that are offered to former workers. and I take you through how that benefit level is calculated. What the Social Security Administration will do is take the highest 35 years of earnings, and that's with an eye towards figuring out the average index monthly earnings amount, or AIME. Basically, all that is what you used to make on average over your lifetime, just on a monthly basis. So index for inflation, how much did a worker make per month is what the first thing that you need to determine. And once that AIME, that average index monthly earnings amount, is calculated, what's done is your earnings are separated into three tiers, basically. So on low earnings, the replacement rate is going to be 90%, and by low earnings, we're talking about up to $791 in that average index monthly earnings amount. Medium earnings are going to be replaced at 32%, and by medium earnings, we consider $791 through $4,768 of average index monthly earnings. That's going to be replaced at 32%. So the replacement rate on medium earnings is 32%. The replacement rate on high earnings, so anything exceeding $4,768, is going to be replaced at 15%. So you see the different replacement rates at the different earnings levels, 90% versus 32% versus 15%. And those bend points, those cutoffs, are going to be indexed for changes in wages, or average wages, not for prices. But once those amounts are figured, what's calculated is the primary insurance amount, or the starting monthly benefit. So as a worker, you may retire early. You may retire as early as age 62 and still claim Social Security benefits, but your primary insurance amount, that starting monthly benefit, will be reduced. You can, on the other side of that, you can decide to retire later than the full retirement age. The full retirement age today stands at 66. If you decide to retire later than age 66, you'll see a little bit of an increase in your benefit. So lots of terminology there, and I've taken you through that calculation to think about, once again, the progressivity, regressivity of the benefit. And so you can take a look at the calculation that's done. So for someone with average index monthly earnings of $5,000, that person's benefit level, that person's primary insurance amount will be $2,019 and some change. That's the calculation that's done, and you can look through. I'm not going to ask you to calculate this on your final, but you can see how that's done. The major point here is that we do see that if you made more over the lifetime, so workers who made more will get back a greater benefit, but to be a little more precise with this line of thinking, workers with a lower earnings history will get back a larger percentage of what they used to make. Relative to someone with the higher earnings history, they're going to get back a smaller percentage of what they used to make. That's why typically higher income workers don't like Social Security as much as lower income workers, because the replacement rates are much lower, as we saw at higher levels of income. So taken as a whole, if we're considering the question once again of how progressive are Social Security benefits, well, the benefits are in fact progressive. They're progressive because they're more favorable for the lower income worker who gets back a higher replacement rate. And notice that there is a cost of living adjustment. So we saw in the lecture on TANF, your benefits aren't automatically adjusted for changes in prices, whereas there's something called the cost of living adjustment. As we see prices change, we'll see the benefits change as well. For 2013, the cost of living adjustment is going to be 1.7%. So people who are receiving Social Security benefits today, they should see a 1.7% increase once the new year kicks in, as a result of this cost of living adjustment. There are certainly different ways to criticize Social Security. There's criticisms mostly from the right, and by the right I'm referring to more conservatives versus the liberals. But there are some criticisms of Social Security from the left as well, from more liberal-oriented, ideologically oriented persons. There's one book in particular by Linda Gordon called Pitied But Not Entitled, where she lays out an argument for how Social Security has basically damaged the whole social welfare structure. So basically the idea is that you have Social Security, which requires a work history, and then you have our welfare system, which doesn't require work history, and so what we're left with is a two-tiered system We have a Cadillac social welfare system for those at the top who have a work history, and then we have our social welfare system for those who don't have the work history, and also the social stigma that attaches to receipt of welfare that results because of our Social Security structure. So you can check out the book if you're interested in this line of reasoning. But really, the major criticism comes from the right, where conservatives charge that Social Security is going broke, that we're in a crisis situation, that it's a bad buy, that we could be getting more in terms of our replacement rates in the private market. We did have some substantial changes in the Reagan administration that were passed as a result of the Greenspan Commission. So we did what was once a 65 age, a full retirement age, was increased to 67 at the time. And there were other changes that were implemented also as a result of the Greenspan Commission. But of course, we have the Bush proposal. The Bush proposal was an idea allowing people to take 1/3 of their Social Security contributions and to let people invest in the stock market in stocks and bonds. But of course, this proposal really had no momentum to it, and so this was really something that really had no teeth to it, and that was abandoned later on. We move to the last part of this lecture. This is considering the Social Security financing challenge. The nature of the challenge stems from what's called the worker to beneficiary ratio, or sometimes also called the dependency ratio. But the crux of the issue is this. Back in 1950, we had lots and lots of workers for each beneficiary. So recall the pay-as-you-go system where current workers are paying for current beneficiaries. We had a system where we had 16 workers per each beneficiary that were paying into the system at the time. And so this number dwindled to approximately 3-to-1 in 2004. And the projection is that by 2035, the worker to beneficiary ratio will drop down to approximately 2-to-1. And so if you think about where that's headed, the idea is that we're going to run out of money. So currently, the trust fund is in surplus. We have about a $1 trillion surplus as of the date of this lecture. But the projection is that by 2017, we're going to have to start dipping into that trust fund to pay benefits, assuming that nothing else is done. So just from a general standpoint, we have to do something either on the revenue side or on the expenditure side. We have to do something about the tax or the benefit. But if you consider some of the proposals that are out there, this is, by the way, this is one of your essay questions for your exam, in which I ask you to consider the various strategies that are out there to respond to the Social Security financing challenge. And among these strategies, we consider a number of these here, but the first strategy that's outlined in your lecture slides is talking about the cost of living adjustment. We had noted that as prices change, your benefit levels will change, but one suggestion is that we reduce that adjustment. So taking one example, we saw that prices changed by 1.7% from 2012 to 2013. So the strategy here would be to reduce that adjustment by 0.5 percentage point. So it wouldn't be a 1.7% increase in the benefit levels, but rather a 1.2% increase. And I'm getting my numbers here from the Office of the Chief Actuary at the Social Security Administration, but this would presumably fix 42% of the problem. And that's the first strategy that's considered. The second strategy is with respect to the benefit calculation. If instead of calculating the benefits over the highest 35 years of earnings, if we increase that window, to 40 years, to the highest 40 years of earnings, the net effect would be to dilute the benefit, dilute the calculation amount, such that it would fix 23% of the problem. That's the second strategy that's mentioned in your slides. The third is in terms of the retirement age. So the retirement age stands at 66 currently, and it goes up by 2 months each year. It should go up to 67 by the year 2027. But the strategy here is to increase that retirement age to 70. So this would presumably fix 36% of the problem. The fourth strategy that's outlined here is to tax the Social Security benefits more aggressively. So once you receive your Social Security benefits, you may be taxed on those benefits if you're still working, if you're still receiving income up to a certain level. But the idea is to tax those benefits more aggressively, much like we do private pensions. And then finally, the last strategy that's proposed here is in terms of the cap. That's limiting the amount of earnings that are subject to Social Security tax. So instead of capping Social Security taxes at $110,000, the suggestion or the strategy is to lift the cap and to let 90% of earnings be subject to Social Security tax. And presumably that would fix 40% of the problem. So as part of your essay question, I ask you to consider what each of these strategies would do in terms of effects on workers, what the effect might be on employers, and also what effects might you presume in the way of the beneficiaries, and to propose your particular strategy. So there's lots of literature out there purporting to say that it would have a negative or positive effect in whichever regard that I've just outlined, but that's your essay question. I'd like you to consider the impacts on workers, beneficiaries, and also the employers with respect to each of these challenges or the strategies that are out there. That concludes this lecture, and next week we'll consider Obamacare, our public health insurance system, and some other topics.